Thank you very much, Sean. Welcome, everyone. So pleased to have you for another session of RM Smart Investing. Uh, Today, I thought we'll touch on a subject, and I call it to roll or not to roll, and that's the question. So uh, there is when we do these option trades and we do use different strategies, most of the time we are thinking either we're gonna close it or we're gonna uh, perhaps just let it expire, and we kind of forget about the third option, which is rolling. And perhaps the reason for that is sometimes it is not understood, or perhaps because if it's could be a lot of work. So I thought maybe for the next half an hour or so, we can kind of dedicate it to explaining what is rolling, what does uh, where does that apply, when do we use them, and what are some of the criteria that I use. So um, number one, what is an option roll? In reality, what it is, it's a closing an existing position that you have, whether it's a single selling an option, you have a shorted option, or you are long an option, or you have a vertical, you have iron condor. All you do is you sell that existing position and you open a similar option position with a different strike price or a different expiration date, or combination of both. The good thing is you do them simultaneously, and we will see what is the benefits of that. So rather than closing the whole position and then go and start opening another one, you can do it simultaneously. So why do we use rolling? And what is the advantages of the rolling? Number one, to manage risk. So it happens that maybe in your position that you're in, you're losing money. It could be perhaps you are selling a naked put, for instance, and it's going against you and you're running out of time. So you want to see if there's any other alternative. So that would be one. Also, it avoids slippage. So basically, if you want, let's say you're very bullish about a position and it's time coming and it's expiring. So you're gonna you say, well, I'm gonna still continue. I'd like to buy more. So you want to close it and then open another one, and that there is that the time element and the price element here, it's done simultaneously. It also, as I mentioned, as far as when you have the risk, sometimes you want to avoid exercising, let's say, a short call or a put. So you want to, your position still, your assumption is the same, but you don't want to be assigned. So that's another way of actually, doing a roll. Sometimes you have profits, or you want to have more profits, or you have the profits and you want to keep those profits. That's another reason you can use the rolling. It also, like managing risk, it limits losses with what your criteria is. And also, if the markets have been changing or this is a movement, you can be versatile and respond to the market changes. So what do you mean by rolls? So there's three main things, which is similar to all the options strategy that you use. There's a vertical. And when you roll vertical, that means you have the same expiration, you just use a different strike price. You could also use the calendar, which is, this is the time. So you still have the same strike price, you just want to use a different expiration. As I mentioned, maybe extending your holdings because of the probability feel is in your favor. Then we combine vertical and calendar. You could have diagonal, which is a different strike price and different expiration. And then we talk about roll. We say roll up. That means you go to higher price. Perhaps things you want to go in the money, so maybe you can roll down if you have the calls. And forward means going to the next expiration date or other expiration dates, so you're going forward. So these are some of the terminologies I thought might be useful. So what option strategies can be used for the rolling, in this situation, rolling up or rolling down? Most of the time it's rolling up, is Uh, you can apply it in long calls or puts. It's not as much applications, but perhaps I give you one example right now so it makes it a little easier. Let's say you own a stock and it has been fantastic. You bought it at like, let's say, 30, 40 cents, and it's really in the money, and you're hitting, it's going to $6, $7, and you're just loving it. So what you could do, you could actually maybe, let's say let's say this stock was in a 10, and now you're way in the money, and basically you can roll it up and go out of the money, and basically this way you actually keep almost all your profits, and you're buying less expensive option. So even if that option expires worthless, let's say something really bad happened and the option dropped big time, because you're not buying out of the money, basically you paid less. So let's say that 30 cents option, which is worth $1, and you spend another maybe 20 cents to buy the other option, you basically held your 50 cents of the profit. So regardless of what happens. So this is one of the techniques that you could use. This is in the long debits. But majority of time, when we're talking about rolling, it comes on the face of credit. It's managing the risk. So if you have short puts and it's, you're close to being exercised, it's like going against you, that's one place you can use it and collect some credit by, and also extending the time. You can use it with covered calls. Again, in covered calls, we're talking about credit, whether you hold the shares or you have the poor man's covered call, you hold the, actually options. We can actually, again, use the rolling to perhaps collect more credit or extend the time. And then we could also use in vertical spreads. A lot of times it's not advisable to do, it's a lot easier to do like covered calls or than just a single sell, but there is strategies we actually can use the vertical spreads when they go against us, and we want to have a way of protecting and managing our risk. So I will use an example, for instance, for that. And when we talk about vertical spreads, well, it brings us to iron condors. When we're talking about iron condors, remember, we're talking about, again, you have this space here, and you're protecting the boundaries. And let's say while you're protecting and your hope is it stays somewhere in the middle, it goes against you in a way that it's moving in this situation. The market has been very bullish, your stock is really moving up. So basically it's going toward your bullish side, the call side, and you're really losing a lot of value on your put side. Can we manage that? And it's similar to the vertical spreads, which just be married with the iron condors, right? So what we want to know though, we want to know when is a good time to hold your position, when is a good time to fold it, and when is a good time to roll it. So you have to know when to hold, fold, or when to roll. So if you have the same assumption as before and they have not changed, if they have changed, then you have to completely change your strategy in the sense of your outlook. But let's say your assumption is still the same. We've done silver or gold, and you still think in 6 months or 3 months, you're still positive, you feel it's going to happen, and we just had a setback. If you have the same assumption, then it makes sense to roll and keep the strategy going. So again, as long as your assumptions haven't changed, this allows you to keep the probability going. So that means that if you extended it, you have a higher probability now, as long as you feel pretty confident that your assumptions are correct. Now, if there's any extrinsic value left in the trade, if there isn't, is really, remember, when you're doing specialty credits, it's all about extrinsic value. If there isn't anything left, perhaps this is a good time to actually roll to get more credit. And I will share that with you with my criteria, how much of a credit you have to really accept. Uh, if is your trade in a sweet spot and profitable? Let's say it's at the money and it's working, and perhaps we think this will continue. So you're profitable, you want to have more profits, so that makes sense to actually roll. The other thing, the negative things about roll is the opportunity cost. Now, granted, you had this criteria, you chose these time, and you invested whatever it was in that, in your position. But what happens is if you're not too sure and you're just doing it in a sense that you don't want to lose your trade, or you want to make, you're still a little stubborn and you say, well, I can, I know this trade is going to work, I'm going to continue with it, and you keep rolling. And sometimes you can roll 6 months, 9 months, and you can, basically, as long as you feel you're on the right track, you can collect premiums, or you can extend your profits if you have a debit, for instance. But if it's not really, you're sure, is it a good place to tie your, basically your capital? If it is, then stay with it. If it's not, then that's opportunity cost. Maybe you could use those funds to perhaps do something else with it, especially if you're like, you have a naked call, or you have a naked put. And again, this way, basically your capital is frozen. So you have to think about those. One last thing is, if you have a debit spread, again, I prefer to do a lot of credit spread, but if you have the debit spread and it is in the money, basically, if it is in the money, then you're profitable. Just close the trade. Don't worry about rolling it and to get more profits on that side of it. But on the other hand, if your debit spread is out of the money and you have very little to lose, and I use that sometimes. Again, I don't recommend this all the time, but sometimes when I have let's say you have the autumn butterflies, or you have iron condors, and one of your legs is really worthless in some ways, and you're so close to expiration in that thing. And sometimes I just let it go. I don't mean what I mean by let it go. I just continue, because things can change. Or you have a leg, and sometimes that one leg which is against you, then if there's a debit side of the leg, sometimes it's not worth it to close it for a few pennies, because things can change, and it has happened to me. So it was like with 2 days to go, all of a sudden there's a merger, there's a takeover, and all of a sudden it goes your way. While you had like a 1 or 2 pennies, now you're a bit in the money. So it is a kind of I call it jackpot or lottery, or sometimes the market goes back to reversion to me. So at those times, just stick with it. Don't close it for a few pennies. Just let it run and let it expire if it doesn't work. So here I want to share some of my criteria in advance of some other ideas that we have. And hopefully they are helpful. Hopefully these are something that they make sense. The first thing I have to tell you is the rolling is more of an art than science. And that's why you don't really have computer programs which they do this automatically. And there's a little more of an experience come to picture. You really want to be comfortable. And there's some people who are really good at it, and they continue doing that. And sometimes they actually, I know some traders who do that options and the futures, and they are very good at that. So you have to have a little bit of a knack for it, and you have to have experience for it. And that's one of the reasons rolling is not a big subject when you talk to a lot of traders or investors, because it does take some subjective ideas or assumptions. The second thing is, as I mentioned to you, I prefer rolling for actually in a selling position, collecting more credit rather than the debit position. You still can do it, but usually it is on the credit spreads, it's on the covered calls, it's very good. And also, let's say if you have a naked calls and you're okay with it, those are the times that you want to roll, and they give you more credit because you're buying time or more price. In the meantime, I have to share this with you that most of the professionals, the professional traders, they don't like rolling. They they just have their assumptions. They stick with it, and if it doesn't work, they move on. And I put down because of their deep pockets. They really have so much available liquidity that they really don't want to, they can start all over again. And they're not really a lot into rolling. I'm talking about big professionals or with big money. On the other hand, it is a pro for the retail investors because they have like usually smaller accounts, and also they have like a lesser of a position, so it's easier for them, especially with the liquid positions. Then that's easier for them to get in and out, and that's why it's not a bad idea for the retail investors. It's kind of an opposite in this situation. They have advantage, so it's good for them to do the rolling. I've touched bases on this, the probability of touch, but when it comes to rolling, you want to be aware of that. What the probability of touch is, especially if you have spreads or you have a short something. Let's say you have short, you're selling a put, make it put, or you have a vertical, a short leg. You want to see what is the probability that that will be touched. And if the probability is high enough, I'm talking over 50%, you have to think about what is your psychologically, what is your emotional status. Do you get nervous when we are in that situation, or it's going against you? So this probability of touch is important. It's it's the same thing when we talk about delta. It is something that you want to watch for and see what is your reaction every time you've had that and touched it. Again, touching doesn't mean it is actually happening. Things touch and then they come back. It's like we use it in expected moves, for instance. They touch the boundaries and then move down. But you also want to watch it to see how you react to it. The other thing is, this is also very important, is when you're rolling, let's say you're rolling up or you're rolling forward, make sure you collect enough credit to make it worthwhile. Sometimes you will, these are, by the way, when I mention it's art and science, these are trial and errors. This is something you have to go through, like the expiration date. You want to watch to see, okay, if I did roll it, what is? And the good thing is, if you use Thinkorswim, for instance, or you use Tastyworks, they're all automated and they can actually tell you exactly if you rolled it, how much it will be. So if you're going to roll something and you're going to get like 4 cents of credit, and after commissions and other things, it is not really that advantageous. So basically, why you want to do it? So I put down minimum credit you want to get is at least 10 cents to make it worthwhile. And again, watch your deltas, and I explain it when we talk about spreads. This is also interesting. There have been some studies done and found out rolling, it works better, especially if you're doing a single positions or you're doing spreads, for instance. It has worked better with the cyclical instruments, such as gold, for instance, such as treasuries. So if you want to use an instrument, it seems like GLD and TLT works better than, believe it or not, than like SPY. So if you want to use an instrument, of course, you can do anything underlying, but as far as the history goes, it looks like that gold and treasuries are better candidates for rolling because of, again, also the trend, and they keep it. So that's another thing. Watch also the extrinsic value. So if there is some extrinsic value, then you want to, milk it as much as possible. If there is no extrinsic value and you're very close to losing it, then that's a good time to actually roll it. Remember this rule that we talk about, especially when you do like butterflies or when you're doing your verticals, whether you want to do a debit, whether you want to do a credit, this probability plays a big role. So the more profits that you think, the chances of getting a large payout is usually the less of probabilities. The more probability that you're gonna achieve your success in your trade is the less of a reward. So we want to watch the payout when you do that. One thing is don't overanalyze. I mean, just keep playing, but don't go, for 2 or 3 pennies. And it just, once you have your criteria, just take a look at it. It makes sense. Just do it. We will talk about covered call, and it's really attractive in that. So if the numbers kind of, tell you whether it's worth doing it or not. One last thing I have to say, it's kind of related, but not related when it comes to, rolling, because I'm going to talk about covered calls, is when you have a position and you want to write calls against it, one suggestion I will make is do not go to the maximum number of contracts against your position. What I mean by that is, again, if you have 1,000 shares, obviously you can write 10 long-term option, or you have 10 long-term options like leaps or like a 6-month option. Do not sell the maximum calls against it. So if you have like 1,000, you can sell 10 calls. I would rather you do it at a tidbit, and I know you won't collect as much, but maybe you can do 3 or 4 at a time, and usually just leave some just for the risk management side of things. So basically, that's my experience. So I usually don't go full out. I usually do the most, maybe 80%. Just a little experience talking on that. So let's talk about covered call. And when we want to do a covered call, basically, as you know, you hold, either you have the shares or you have a longer term option, and this almost looks like a diagonal most of the time, or it could be calendar, but mostly diagonal. So you have this in the money, perhaps call or at the money, and you want to go out of the money and sell calls against it. So what happens is, the beauty of this is you can actually, if it is somewhere that you have a position that is going against you, then maybe that's a good time to extend that and go, or if it's going to be called and you want to avoid that in your cover call, let's say it is exactly the same price that your call is gone beyond that. Let's say the price has gone over that. Perhaps you can actually, what you could do, you could roll this call before the expiration and move on. Usually, again, this is done depending on whether you use the weekly. Usually it's good to do, people do a 90-day, 45-day, it all depends what you're using. If it's like a naked put, remember, we usually recommend 45 days or so. But if this is getting very close to expiration, then start doing that. But you can also wait till the expiration date if you wanted to see what everything is working, and you have the time. And then as long as there's liquidity and everything, just then go ahead and roll it for your covered calls. As I mentioned, like a Tastyworks has, like, it says roll at the expiration. So you actually have that little button if you use that Tastyworks. When it comes to credit spreads, so when you're going to roll is now your short leg. Remember, we talk about delta. The delta you want to use, again, most of the time you want to have a 0.3 or under, let's say 0.25 even, delta, because you want to make sure when you have your short leg is not going to hit that short leg, right? So the probabilities you want to be as low as possible. Let's say it has been going against you, and now you're at the money or in the money, and what is happening, your delta is past even 0.5. You're at 0.58, which is this really danger zone. So if you see your delta has gone against you and is past that 0.5, then find a leg that you can move in. And again, by practicing, make sure you get the credit, whatever you use, and then roll it immediately. Talking about vertical spreads, so let's talk about iron condor. Iron condor, as you know, there are 2 spreads, right? 2 vertical spreads. So I just use an example, so hopefully this helps you. So let's say your stock price is rising really quickly, and it's very much close to the upper edge of your spread, the call side, and your put spread is way out now. So remember, this is your boundaries, and this spread has nothing. So basically, your meat of the profit will be around here, but now you are here. So what you could do, you could actually move up this spread. So let's say this put spread was 145 and 140. What do you want to do? You can move this up to 150 and 145. So because we moved up the put spread, obviously we are a lot better positioned than the previous one. So we will collect credit for this because now we moved up. One word of caution is do not improvise and use different spreads. If your spread was 5, keep it exact same spread. So what happened here, okay, the call side, looking good in this situation, but the put side was doing nothing. So you're really losing on your iron condors. So what you were doing is now you have pushed it up. By pushing this up, you have received more credit. Usually that's what happens. So give you an example. Let's say your original credit with that leg was 150, and the total, when we looked at, you had collected 150. By doing this strategy moving up, what happens now, your 150 becomes, let's say, $2. And because it's $2 and the spread is 5, you accomplished 2 things. Number 1, you collected more premium, so that means more profit. Number 2, your risk went down. Remember, the risk was 5, that's the maximum, that's the spread, minus the credit you received. So if everything goes against you, you will lose $3. So you went, let's say it was 150 and 350, now you're at 2 and 3. We go back to the rule of probabilities and the credit or the reward that you receive, the risk and reward. So because you got more credit, now the chances of hitting your objective is less, because now what we did, we closed these boundaries. What happened was now the ranges are narrower. So in order to accomplish our original objective, we have to make sure things are basically in a way that is in a neutral way. What does that mean is, remember, when we do iron condors, we don't know which way it's going to happen, in a sense. But when we are now pushing this up, this put vertical spread is really went from the negative or from the bearish side to more neutral, because again, we closed that gap. So by doing that, we changed our really criteria, but also remember, we had position delta. So if the things turn around and all of a sudden from that call go down rapidly, then we really reduced our profitability in that sense. And what happened was, because of that, the delta actually becomes, gets neutralized. So if the delta was, for instance, the put that there was there, and let's say it was negative 24, I just use a negative 18. When the things went down, we would have made more money. But if we neutralize in that, we go to 9, and when it goes down, we don't make as much money. So I hope it's not confusing. The bottom line is, if you have an iron condor and it goes extreme one way or another, I use a call, it could have gone the other way. You can repair that by moving up, rolling up your in this case, the put vertical. In this way, you can actually collect more credit as long as you feel that the direction is still positive, it's going to go up. So this way, as I mentioned, let's say you had $1.50, now you have $2. So you're not losing completely at the put side of your vertical. I want to use a little example. It's not 100%, but I want you to understand what does that mean. It is, let's say we have a January 2022, January 21st call. It's a 175 call on gold. You're bullish about gold. So you decided to buy this today. So these numbers are as of today. So you pay $3.65 in the middle, and the price of gold today closed at 167.46. So it's, it's out of money, but you feel by then it's going to be up there. So you're happy about it. You're happy that you can hold this for another 5 months or so. So this is your core, and you buy 10 contracts at this stage. So what happens? Then you come and turn around and you say, you know what? I'm going to go ahead and sell a call, maybe 5 calls, for instance, as September 17th against my my position, which I have 10 of them. So what you would do, you would collect 25 cents, and basically your odds of the probability of the touch, this is about 16%. Your delta, on the other hand, is only 0.9. So this is a good option. Of course, again, we're talking just today. So I looked at the, like, you were going to do September 3rd or September 10th, you would collect maybe 3 cents and maybe 8 or 9 cents. It was not worth all that work to collect like $45, for instance. So at least you get something here. Maybe you can go a little farther and buy something the next couple of weeks from then and do the same 177, for instance, and collect 2 weeks further, maybe 2 or 3 contracts and collect another 40 cents. So there's like a 170. Now this is in the money, so I would not recommend that, but then it is pretty juicy. And let's say for some reason you got this and now this is going against you. So remember, this one you collected maybe 130, and let's say you just did it today, and then you said after the fact you go, oh my God, what did I do? This thing is, the probability of touch is about 66%. So that's pretty high. And although the delta is about 34, so granted, I did receive $, let's say 30. Is this worth doing this, for September 17th? So there's the buyer's remorse right now. So what you want to do, perhaps it might make sense to roll it a little. Now we want to repair this, and that's the reason you have to watch that you really don't want to do it in the money. So you want to go out of the money, and you look at, that's why you have to do a little study. You go through the basically all the expirations. So in order to repair that, either you could have just closed it and start everything all over, or you can actually roll it, and we can see now we can go to November and we have a 177. So the probability of touch is 45. The delta is 25. So that's attractive. It's under 30. And we still, in this situation, we do get credit. We go from 170 to 177. We reduce our probability of touch. We collect another 50 cents or so in credit. Of course, we extended the time. So we're talking about 3 months. So that's the trade-off. But if you were very much in a position that you thought, you know what, my gold is in a good position, but it's not going to happen till like December, January, then this is one of the ways. Of course, I would not recommend, go that far. For selling covered calls, you want to be able to do like every 45 days or 30 days. So you want to take advantage of the theta decay, right? So basically, you want to go, again, out of money, but enough premium. And again, watch this probability of touch and watch your delta. So in this situation, you want to make sure you go out of money. So that's basically it. Again, I want to just give you like an opening the door as always, just hopefully give you a little more confidence and more comfort to try these. Again, Thinkorswim allows you to do the role. Tastyworks goes a little beyond that and actually has another extra line that rolling on option exploration or exercise. And you can also do that. With that in mind, I very much appreciate your attention. I hope it was helpful and useful. And what I'm going to do, I'm going to go ahead and stop recording. And